This video is a bit of a warning. It's a bit of a wake-up call, especially for those of you that fall into this trap. And this trap is so many traders think that to be a successful trader, all you need to do is focus on the one strategy, the one perfect strategy that's going to be a winning strategy for you. You're going to find that one right strategy. That's all you're ever going to trade. And you're going to make all kinds of money trading the one strategy. And many of you guys also focus way too much on single positions. You open a position, it's all about that one position. For example, if you're buying or selling an option in a particular underlying, when you're making that position, all you're focused on is that position, that one position. You don't think about how it fits your entire portfolio. And this is where, as you get a little bit more experience as a trader, and you no longer focus on single strategies or single positions, you think about your portfolio as a whole. And when you open new positions and you're trying to decide what strategy to use on that particular position you're about to open, you're more trying to figure out how it fits in with your overall portfolio rather than focusing on that trade as just the one trade, as its own separate event. Of course, my favorite option strategy is the wheel strategy. And of course, I wrote a book called The Super Wheel Option Strategy, which talks about my variation of the wheel strategy. And the reason I created my super wheel strategy is because I didn't like the traditional wheel strategy. It was a little bit too limiting because the traditional wheel strategy, it consists of cash secured puts and covered calls. Both of those are very similar strategies. Both of them are bullish strategies, and occasionally as a trader, especially as you gain more experience, you understand directional risk, you understand delta risk. And with the traditional wheel, if all you're doing is constantly selling cash secured puts and constantly selling covered calls, constantly putting on bullish trades, essentially, right? You're going to start getting way too many long deltas. You're going to start getting way too long the market, and you're taking a ton of risk. And you want to reduce your risk sometimes. And a way to reduce your risk, of course, is to reduce your deltas. How do you do that? Well, you put on some occasional bearish trades or some directionally neutral trades. And that's really what my super wheel strategy is all about. It's, managing your deltas. If you find yourself running the wheel, putting on some wheel trades, and you find yourself uncomfortable, you put on too many long trades, let's put on some bearish trades occasionally, or some directionally neutral trades. Find some ways to bring that delta number down. And that's what I want to talk to you about today, is because a lot of new traders don't understand this, because I keep getting this question asked, how do I choose a particular strategy on a particular underlying? And typically what it is I determine, do I need more long deltas? Do I need less long deltas? If I need more long deltas, I'll just keep running the wheel. I'll keep selling puts. I'll just sell some puts, right? But if I need to reduce my deltas, then I might put on some bearish trades like a call credit spread or a put debit spread. Or if my deltas are exactly where I want them, but I still want to put on some new trades, I'll put on directionally neutral trades like strangles or iron condors. So let's talk about some of my thought process when I'm putting on new positions. So I'm going to go to Apple. I've already got an Apple position on. I've got a short put in Apple that I actually just put on a couple of hours ago. And the reason I put on the short put is because I love short puts. They're my most common trade. They're my favorite trade. They're very easy to understand, right? It's a bullish trade, and I'm bullish in Apple. Also, my overall portfolio right now, I don't have a lot of other short puts. I've got one or two and some other things. I've got some neutral trades and some stuff as well. But overall, I don't have that many long deltas. So me adding some long deltas by selling a put in Apple is okay. That's the reason I chose that. That's my go-to trade, selling a short put. But what if I had too many long deltas? If I had too many long deltas, then selling a put doesn't make sense, because I'm just going to add even more long deltas. So what I might do, instead of just selling the naked put and receiving like a 90-cent credit, what I could do is I could also buy a put. Now this creates a put debit spread, which is a bearish strategy. And if I just wanted short deltas, if I just wanted to actually reduce my number of deltas, then putting on a put debit spread would actually reduce my overall portfolio deltas, right? But if I'm still bullish in this underlying, what I could do is let's actually double up the short puts. So I'm creating a put ratio spread. So I've got two short puts and then I'm buying a higher price put. Essentially what I've got is a combination strategy. The put ratio spread is really two strategies in one. It's the short naked put, which is a bullish strategy, and it's also the put debit spread that's also embedded in it, and that's a bearish strategy. And the bearish strategy is a little bit less short deltas than the long deltas of the bullish strategy. So still, it is a long strategy, but it's not as long as a single short put. So I would use the put ratio spread if I still wanted some long deltas, but I didn't want as many long deltas as just selling a naked put. So the put ratio spread, still bullish, but not as bullish. You can see if the stock goes up, I'd make $170 at expiration, and if the stock comes down, I actually make even more money if I held the stock to expiration and we finished directly on top of the 180 strike where the two short puts are. I would make $615, but I'm not going to hold till expiration. But what the short put ratio spread does, it reduces your deltas, and if the stock falls, you can make a little more money, right? You actually have a chance to actually make a large sum of money if it falls slowly enough and eventually creeps into this little tinted area here. Also, what the short put ratio spread does is it lowers my break even, because if I had a single short put at the 180 strike, then my break even is that 180 strike minus whatever credit I receive. So if I received $1, my break even would be 180 minus $1 would be 179, right? That would be my break even. But you can see the put ratio spread by having that put debit spread, which profits as the underlying stock goes down. It actually lowers my break even all the way down to right around 176.67 in this case. So it basically lowers my break even by about $3, $2.50 to $3 in this case. So again, that gives me a little bit more runway to be wrong. So, this is a great thing to do. This is part of the thought process. If I needed if I wanted more protection to the downside, if I wanted to reduce my overall deltas instead of selling the short put, I might do a put ratio spread. Some other things I might do instead of just a single short put to also reduce my deltas. I still want to be bullish, but I don't want to be that bullish. Instead of adding the put debit spread to create the ratio spread, I could sell one short put and then I could sell a credit spread. This creates what is known as a jade lizard. Again, it's essentially a combination of two strategies. You've got the short put, which is bullish, right? And then the call credit spread, which is bearish. And what happens here is, if I go to the analysis, you can see it's essentially a neutral strategy. We want the underlying to stay in a range. We don't want it to go too far up, but if it does go up, we have capped our upside risk by doing the call credit spread, because in this case, I'd lose, looks like I'd lose $131. If I move it in by $5 here, I've essentially, now I'm barely losing anything to the upside. I could actually play with the strikes if there were more strikes available. They don't have dollar-wide strikes, but if there were dollar-wide strikes available, I could actually move this thing in to the point where I can lose nothing to the upside. So this is really how a jade lizard should be put on. And again, because you put on a bearish strategy to go along with that naked put, that call credit spread, again, it's a bearish strategy. It makes money if the stock goes down. Again, you lower your break even, where again, the break even on that 180 put would have been around the 179 strike. By adding the call credit spread to create the jade lizard, again, my break even now is all the way down at 177.29. So I lower my break even by about $2 in that case. And of course, these are all assuming I'm either bullish or just very slightly bullish to neutral. What if I'm actually bearish on Apple? Well, if I'm bearish on Apple, obviously I'm not selling a put. I'm not doing a put ratio spread. And I'm probably not doing a jade lizard either. If I'm bearish, what I really want to do is I either want to put on a put debit spread, right? So we're going to buy a put and then sell a lower price put, and we want the stock to move down. Or if I wanted to do this as a credit trade rather than a debit trade, I'd put on a call credit spread. So either one of these, the put debit spread or the call credit spread, either one of these works as a bearish trade. They also are short delta trades, so they're going to lower your overall portfolio deltas. Now, which one of these you choose, whether you choose the put debit spread or the call credit spread, depends on, well, do you want to have a trade that's a credit trade? Do you want to receive a credit for putting on a trade, or do you want to pay a debit? And typically how you determine this is what is the IV rank of the underlying stock. In this case, Apple's IV rank is at 30. 30's okay. 30 is definitely okay to where I don't mind receiving a credit. I don't mind selling premium. So I'd probably do the call credit spread if I wanted to put on a bearish trade on Apple. Now, if Apple instead had an IV rank of like 5, something really low, then the debit spread really makes a lot more sense. Then I'd probably put on something like this put debit spread here. And again, I'm giving these examples, but none of these trades are trades I would put on just thinking about Apple. Just hey, I want to trade Apple. What do I want to do in Apple? It's not about Apple. It's about how that trade in Apple that I'm about to put on, how it fits the rest of my overall portfolio. If I have a ton of bullish positions already on, I don't want to sell some naked puts in Apple, right? I want to do something else. I want to either put on some just slightly bullish trades like ratio spreads or jade lizards, or I want to put on some bearish trades like put debit spreads, call credit spreads, or in some cases, what you'll find, and this happens to me all the time, is, my portfolio looks just fine. I'm not too long. I'm not too short. My deltas are exactly where I want them to be. So in that case, I'd rather put on directionally neutral trades because I don't want to mess up my deltas if they're exactly where I want them to be. So in this case, I'd probably do a directionally neutral trade like a naked strangle. So I sell a put, I sell a call, and this is done for a credit. This is a credit trade, so it's short premium. You put on this trade when volatility is reasonably high, and again, Apple's IVR is pretty good, so I would probably just sell a strangle in Apple if I didn't want to add any long deltas, and I also didn't want to add any short deltas. I wanted to remain directionally neutral in this case. Now, if this underlying Apple is too big for you to trade naked options in, the buying power is too much for you, instead of doing the strangle, you could buy the two long wings here and do an iron condor, which again is a neutral strategy. It's not going to add any deltas. It's also not going to reduce any deltas. It's a directionally neutral strategy. It's a delta neutral strategy. And this really is kind of like the next level, when you're new to trading, when you're kind of a trading novice, again, you think it's all about the one strategy. You're just going to pick a strategy. I'm going to run the wheel, and all I'll ever do is run the wheel, or I'll sell strangles. All I'll ever do is sell strangles, or whatever some trading guru is promoting on the internet. They have a put credit spread strategy where they sell put credit spreads on SPY every single week, and that's all you'll ever do. And as long as you do that, you'll make money. No, that's not the way. You're going to lose money doing that. You have to think of your portfolio as a whole. That's the trade. The trade is not any one underlying. It's not my Apple position right now. It's not my AMD position right now. That's not the trade. The trade is all of these positions together, and the risk profile of them together. And the cool thing with TASTYTRADE as a trading platform, I can actually take a look at my risk profile of all my trades. I click on the P&L tab here. This is my risk profile for all of my positions as a whole. And you can see, if the market goes up, obviously I make money. If the market goes down, I don't make as much money, but I still profit. If everything goes to expiration, I'd still be up. Even if SPY went down from where it's trading now, around 533 or so, it went down to under 500, I'd still actually break even, right? Now, the market would actually have to drop a lot for me to really start losing some serious money based on my P&L graph here. And the reason is I don't just sit around and put on short puts all day, right? I have some short puts. I had the Apple short put because I wanted to run the wheel on Apple. I've got some AMD short puts. I got the one short put on AMD, right? But, I've got also a lot of directionally neutral trades right now in Enphase Energy. That's a strangle, right? GDX, which is the gold miners ETF. I've got a strangle going on in that. NEE, I've got a short put. NEM, which is Newmont Mining, a gold mining company. I've got a short put. If I go down here to Shopify, I've got a long call vertical. So this is a call debit spread, right? So again, it's actually not a short premium trade. I'm actually buying premium. It's also directionally long. So it's actually not a short trade. It's actually a long trade. I mix it up, in all these sector ETFs. XBI, I've got a strangle. XHB, I've got a strangle. XLE, I've got a strangle. I've got a lot of different things going on here. And a lot of these trades at the time when I put them on, again, it was not necessarily, yeah, this is what I want to do in that particular underlying. It's, hey, I've already got all these long deltas. I've already got long deltas in AMD and Apple and some of these other products. I want to trade some of these sector ETFs. I don't need to get long them because there's too much correlation. If I'm putting on nothing but directionally long trades, let's put on some bearish trades. Let's put on some neutral trades. And again, if you're new to trading, if you haven't been trading that long, you don't want to fall into the lies, to all the BS on YouTube and TikTok from the fake trading gurus where they're only promoting their one strategy because they're selling some course on the secret sauce strategy to trading, right? And it's always, you just do this. You just put credit spread on SPX or SPY or what. You sell iron condors every week and you make a ton of money. No. You can't do that. If all you ever do is focus on one strategy all the time, you are guaranteed never to make any money trading. Just some food for thought. Peace, guys.